So yeah, I'm just trying to figure out how much house I can afford and how it all works.
Generally speaking, the way lenders will determine how much they'll loan you is by calculating what's called your debt to income ratio, or DTI. And basically, debt to income ratio is just your total debts, meaning your monthly payments. And so start with the housing cost, taxes, homeowners insurance, principal and interest on your loan. You divide that by your gross monthly income. And of course, you add to your housing cost and the other debt you have. You have a car payment, student loans, those kind of things. So whatever those monthly payments are, divide that by your gross monthly income before any deductions. And that's your debt to income ratio. And typically, you want to keep that under 50%. There are some programs that sometimes will allow you to go higher than that. We can talk about that later. But it's always easier to illustrate with a real life situation. Real house, real financials. A few of the things that can affect your options are how long you've worked at a certain job, and whether you're making salary or bonus or overtime or commission, how your credit score is, and as we talked about before, whether debts you might have. So if you can give me some of those specifics, I can illustrate how this works, and we can kind of look at what your options are. Because there's different loan products for different situations. What you've told me so far is very encouraging, but we'll dig into the details and see where that takes us.
Great. So essentially, yeah, I'm a CPA and I work at a firm in the Seattle area. I've been there for a year and a half now. I was in college before that, so just came straight out of college into that. And all of that is salary. I make $100,000 per year salary. I opened a credit card my last year of college, so that hasn't been going too long. That's basically the only one I have going, but I always pay it off and keep it pretty low, a low balance on that. So right now I've been seeing some reports. I just get kind of a monthly update, and it looks like I'm around 720 is kind of my sense. And I don't have any other debt, no student debt. I don't have any car loans, anything like that. And I've got about $40,000 saved up that I've set aside, that I'm willing to use for a down payment.
Okay. Very good. Well, those are great numbers to work with. Kind of will give us good fodder for having this initial conversation. First of all, one of the things I always like to clarify, a lot of times people equate down payment with total cash available. And they think I've got $40,000 and what's communicated is I've got $40,000 down payment, but maybe what they really mean is I've got $40,000 to buy this house and that's it. Because typically there are three things that require cash. Down payment is the most intuitive of those, but then you have costs associated with that, loan cost, and then prepaid expenses. You have to pay some things in advance. And so, depending on the price point, will determine how much additional you need over and above your down payment. We don't need to get into all those details right now, except that I kind of need to know from you is 40,000 what you're all in cash in, or is 40,000 truly what you have in down payment, and you've already sort of factored in that maybe you need another 10 grand for.
No, yeah, that makes sense. Yeah, that makes sense. 40,000 is what I have available. So that's for everything.
So this is all in. Okay, very good. In terms of your work history is great. Whenever you are in a salary position, it's a fixed income. You know what it's going to be every month. And so an underwriter doesn't need a long history of that to be able to predict what it's going to be in the future. Now, if you're making 100,
even though in less than 2 years, that might be okay.
Yeah, that's going to be fine. Now you do typically want to see a 2-year work history, but I've even had loans in the past where we used high school jobs, to make that 2-year work history. Even if you work part-time in high school, so generally you like to see a 2-year work history, but when you're coming out of college, if you are working in a field, and this is really kind of loosely sort of policed, monitored, defined, if you're working in a field that relates to that degree that you got, that 4 years of college or however long you spent in college counts toward your work history. And so, in your case, if you got a 4-year degree, or CPAs a lot of times have 5-year degrees, then you really have 6.5 years worth of work history. And you could have qualified for a loan day one out of college because you have a salary position. There's no trouble understanding how much you're going to make. And you can even use future income in that situation, where let's say, you graduate from college in May and your job starts in August, but you found the perfect house in July and you're ready to buy, you can even use that income to qualify. So length of time is fine because it's salary. Now, if you were hourly, wholly different story, and particularly variable. Sometimes hourly can work right out the gate as well with a new job. If you can get very explicit guarantees that there's an explicit guarantee of X number of hours per week.
Yeah.
Sometimes we can use that because, you can do the math, X hours times the hourly rate. But anytime there's a variable component, then that's when you need to start factoring in some history of work. And that can even be the case where, let's say that you work, let's say you work at let's say you work at Costco and you're an hourly worker, and then you go to work for Lowe's as an hourly worker, doing similar work. You work in the warehouse, you move stuff around. Even that can be problematic. You're going from one variable to another, and let's say, you are variable at Costco and you're variable at Lowe's. Even though they're, essentially the same type of job, but they're two different companies, and now you still may need some time to establish that. But in your case, very straightforward. Your salary, we can use your salary right out the gate. So I don't see a problem with that whatsoever. Your credit is great. Good job on establishing that. You said you established that in college, so that means you've had this credit for at least a year and a half. You say you have no debt. Does that mean that this credit card is all you've ever had? You never had any debt, or you just had some other debts that you paid off? Or is this credit card really the only thing that you've ever had?
Yeah, this is pretty much it. I never took out any loans for college or car loans or anything. So I just opened it. Yeah, I don't know if this counts as a debt. I just, I pay it off every month.
Definitely, yeah, it definitely counts as a, for purposes of generating a credit score. Absolutely. It's what they technically call a trade line. You have one trade line. One of the things you may consider doing, if you haven't gone back, I'm sure that if you've paid it off every month and always made your payments on time, they've probably offered to increase your limits over the years that year and a half that you've had this. And generally, I would encourage you to take those increases as much as you can. Now, obviously, you have to factor in your own personality and temptations and that kind of thing. But you're you come across the kind of guy who can manage things well. You're not tempted to spend everything you've got. You pay your credit cards every month. And the reason you want to do that is one of the things that may be keeping your credit score at 720 instead of maybe higher is that they granted you a low ceiling when you first came out of college. They said, sure, we'll give you a credit card, but maybe you started out 500, maybe it's gotten to 1,000. But now you're into your career and you're spending money on a monthly basis, even though you're paying it off. You're spending up on that credit card over, let's say, a third of it. And typically you want to keep that down to a third or less if you can in order to optimize your credit score. And the other thing you might want to do is get a new credit card as well, because just having multiple cards, can also improve your score. Your score is not bad where it is.
Yeah.
But it could be better, and that translates into better pricing. That's just the way it is. It's the industry practice what's called risk-based pricing, and the higher your score, the lower the risk, and therefore generally, if the going rate today is 6.5%, but that's for someone with 740 credit. If you have 720 credit, maybe they'll say, well, we'll give you a 6.5%, but we're going to charge you an extra few $1,000s for that rate. So, that's how that translates. Okay. We can look at your score, and we have tools to take a look at your credit report and then do what's called what if analysis, where we can say, look, what does it take to get me to 740? And there may be some very simple things to do. Generally,
I really you should be careful. Like you mentioned, opening another credit card. If I'm looking at buying here in the next couple months, would that hurt my credit or would that be fine?
It depends on the particulars
Yeah.
of your card, and so that's just something what generally we recommend doing is pulling a soft credit report. We will do that, and the score you're seeing is not a mortgage score. Different industries have different algorithms that they use. The car dealerships have their own. The credit card companies have their own. Insurance companies have their own. So you may get a score, even a Credit Karma type score. That's not a mortgage score. And good is good is good. So if it's good in one system, then it's probably going to be good in another, but it doesn't translate very precisely. And so it would be a good idea to go ahead and pull a soft pull, so it doesn't count as an inquiry against your credit. It can't hurt your credit in that way. It's basically ignored for purposes of scoring purposes, but it gives us more data then to evaluate, should we risk another credit pull, an inquiry, or opening another account to see what that would do to your scores. And so, but yeah, I think it is something that's you need to be aware of, that possibly
Okay.
opening another account could have a short-term negative impact. What we can do is what I generally recommend. So I'm just taking your income. You're making about $8,300 a month.
Yeah.
So from a qualifying standpoint, two of the things you got to think of, obviously, is qualifying, but also your own kind of internal budgeting. And generally what I find is people with good credit, like you have good credit and you have a perfect history. Your score isn't perfect and your score isn't optimal for optimizing pricing, but that's just because you're young and your credit's thin. And again, we'll take a look at that and see if there's ways that we can kind of move that upward. But your history is perfect, and you've been doing this for a year and a half, and you've shown the ability to handle this. And generally, when I have people with your profile, I can usually qualify you for more than you'd be willing to take on yourself. That's kind of the generally what happens, is because you think about it, you don't need me to tell you, no, you really can't go that far. So if you're making $8,300 a month, you could qualify for about $4,150 a month in housing payment, because you have no other debt, and that's 50% of your gross monthly income.
So it doesn't matter what's like after, they don't use after taxes. It's just
no, it's gross. Yeah, it doesn't matter what you put in your 401k. It doesn't matter what you net at all. It's not your take home at all. They're looking at your gross.
Okay.
And of course, the metrics that they use factor in those automatic costs like payroll taxes and those sorts of things. Those are factored into the metrics. They're not explicitly there.
Yeah.
They're in the DTI limits that they consider. So you'd be at like $4,100 a month that you could handle. Now, whether you'd be willing to take on that is a wholly different question. And sometimes the other thing you could do. I mean, are you single? Are you married? Are you?
Yeah, I'm single. Just me.
So you're a single guy, and so you may be able to look at this and say, look, my income's going to grow in the future. I have friends that I'm living with right now, and actually they would love to live in a house, and I could rent a room. There's all kinds of ways to leverage into more house maybe than you'd be comfortable with paying on your own, but that really becomes something that can only be considered when you start to compare actual real houses in your price range. When you say, okay, 450 to 600, that's a pretty good price range. And maybe you look at that and you say, look, there's just nothing interesting at 450,000. I'm really going to have to get closer to that 600. And at that 600, with my $40,000 down, I am starting to tip the scales at the top end of where I can qualify. And that's where you just, that's where you have to start to look at it. But what will be, I think, super helpful for you is go ahead and look on Zillow, whatever your favorite property app is, real estate app is, and go find something near the bottom end of your range. Go look anywhere, look and see it. And it can be already sold, it can be pending. It doesn't have to be something that's actually for sale right now, because you're not in that mode right now. You're just in learning mode right now. So go into, find something that's near the bottom end of your range, and that where you look at it and say, yeah, I could kind of make that work. If that was the best I could do, I can make that work. And then go find something at the top end of your range where you think, boy, if I could afford that, that would be amazing. and send me those properties. Because
Okay.
what I'd like to do then is take your details that you've given me. We've got some pretty straightforward things. We've got a credit score. We don't know exactly that. We'll confirm that with a soft credit pull at the appropriate time. And we've got your salary. We know there's no other debt to speak of. We know you've got about 40,000 all in to make this work. And so we can take a look at those things and start to put numbers on it. And where that really helps you is, is it's not just a number, a monthly payment. It's a monthly payment that is contextualized with a real house. Because right now it's all very abstract. You just got, I want to buy a house. That's a great thing. And I kind of like this price range. But until you translate that and you start looking and go, okay, there's a really cool house that could really work. And then we show you what the monthly payment can be. That's when you can start to make those second level decisions about, okay, there are some things here that I might need to stretch for, or, this actually works. The situation I've got, the payments I've kind of intuited so far, it all kind of works and I can actually qualify that. So sometimes it's more about, okay, let's compare what my internal, budgeting, my externals, salary and job, what I can qualify for, and then let's compare that to the market and see where those things come together. And I'm convinced it can be a good spot for you.
Got it. Yeah, that's super helpful. So yeah, I'll take a look around and send you some houses, and I'd be curious, once I send those over, because I've read about different loan types too, and yeah, just be curious if you can break down the options once I send those over of what loan type would be good and why, and because that's a little confusing, and maybe I can, yes, like you said, start to get an idea of what a monthly payment would look like, and that'd be super helpful.
Perfect. Well, I'll look forward to doing that. I'll look forward to your email. And really appreciate you reaching out, and I'm excited for you. This is an exciting time. Don't let the market in any way discourage you. There's a deal in every market, as somebody once told me, and I believe that's true. And I think it's a wonderful time to be looking. There are properties that are sitting a little bit longer now. It's not a buyer's market by any means, but it's not the white hot seller's market it was either. And so I think it gives you, the buyer, kind of first time buyer, the luxury of looking around, of surveying what's out there, and maybe finding just that right property.
Yeah. Awesome. Great. Well, thanks, Chris.
Yeah, you're welcome. Thank you.